dollar is a currency which is acceptable around the world, and the entire world economy runs on dollar. Before 2014, the dollar was around 62 Indian rupees. Now it's 85, and some experts claim that we are running towards 90, 95. So what's your view on that? Is dollar actually strengthening, and how will it actually impact India?
Initially, after the election, everyone wanted to be overweight U.S. equities. After April 2nd, people had second thoughts. I think a good chunk of foreign investors selling their U.S. assets, selling bonds, selling equities to buy Indian equities or Japanese. So the selling of the dollar, and a lot of it, is what drove the currency down in the short term.
So are you still bullish on dollars?
I probably wouldn't phrase it quite that way, but if you go back to the initial analysis that if growth is relatively higher in the US, interest rates are relatively higher, that should support a recovery in the dollar to some degree. So now your question is, okay, what happens next? And again, I'm going to be very humble here and say, I don't know.
All right. So welcome to another episode of Dhan's podcast. You're with me, Ansh Arhiran, and today we have a very special guest with us. The guest is Mr. Daneil Morris. Ta-da! Welcome, sir. We have Mr. Daneil Morris all the way from London with us. And if you don't know who he is, let me tell you. He's the Chief Market Strategist and co-head of BNP Paribas Asset Management Investment Insight Center. So welcome to India. And it's a great pleasure having you on the podcast, sir.
Thrills for me.
Sir, multiple multinational asset management firms and research firms, and then decades of experience. You sound like a smart guy, right?
Well, I survived this long.
Okay. So, my problem with smart guys is they think everybody else is also very smart. So when they speak, they use a lot of jargons and those, complicated terms, which they think everybody understands, but they don't. So let's not keep this podcast that way. Let's just, break down everything. Let's just make it like a classroom session today. Okay. Let's just, you break down everything. You make us understand everything in a way as simple as possible. Deal, sir?
No problem.
Okay. Let's start. So let's start with the hot topic. And that is second term of Trump administration. Right, you are an expert, about the global markets and the macroeconomic factors, and you look at, of course, like the global economics and politics. They are very much connected. So, and everybody is saying that the first term was different, and the second term is giving us different hints, right? So please tell me, what do you think about the second term, and what do you think it's going to be the impacts of this new Trump, actually, we can say, on the markets?
I think the most interesting thing about what's happened so far is how it's been almost entirely contrary to what people expected.
Yeah.
You think about the way people reacted with the election results. So initially, of course, significant surprise, and then an assessment of, my gosh, well, what does this mean? And the initial reaction, frankly, was pretty positive. U.S. markets rallied. When I was with our clients, other asset managers, insurance companies, pension funds, and they're looking at the world and trying to think about, well, how do we want to invest our money? And what was quite interesting, but also a bit worrying at the time, is everyone seemed to prefer U.S. equities. So they were overweight U.S. equities.
Yes.
Now, that made sense at the time. I think, honestly, it was the same view that we had. We thought that was the right view. But at the same time, you were a bit worried when you have a view that's so widely shared across so many different parts of the financial industry, because it suggests that if something goes wrong or if there's a surprise, the reaction of the markets can be quite violent. And that's essentially what happened. Yeah. So with the announcement on April 2nd, with Liberation Day, I don't know how liberated you feel, but we saw a quite significant reaction in the market. And the point is that partly reflected how, at least the market's expectation of what it meant for the economy, so kind of the fundamentals, as we say. But it was also a lot of people realizing, gosh, maybe I don't want to be so invested in the US. I maybe want to invest elsewhere. And since everyone's doing the same thing, the markets react that much more.
So how are the fundamentals changing because of the Trump's administration?
Yeah, well, you really have to think about what we think it means now and then what it's going to mean a bit later. So what I mean by that is, what are tariffs? Okay, so it's essentially increasing the price of goods that are imported into the U.S. So you just think of it as a tax. So imagine taxes are going up essentially.
Yes.
So that's generally not such a great thing. No one likes paying more taxes, as far as I know. And what it means is that, at least in the short term, in the U.S., growth is going to slow down just because things are more expensive. We saw this through COVID and everything else.
Right.
So that's probably the less good news in the short term. But then you think about, what is it going to mean later on? And at least what the Trump administration is trying to achieve here, I'd highlight two things. Mm-hmm. So number one, if it costs more to import something into the U.S., correct, as opposed to something that's made in the USA, there's a clear financial incentive to buy things that are domestic. So what you want to do is encourage companies to produce more in the US, and people will buy that because it's going to be relatively cheaper. Okay. Now, is that so good for other countries? For India, for example, that maybe was exporting goods to the US? Maybe not. But Trump's president of the US, so he's going to be primarily concerned about what's good for the US.
But is this really going to help in the long term? Because, see, the problem with the US is capital is abundant, but the labor is very expensive. Mm-hmm. And that actually increases the price of everything which is produced in US, mm-hmm, mm-hmm, right? Compared to China, yeah, right? And in India, of course. Mm-hmm. So even if they start producing in US, do you think they'll be able to achieve those economies of scale that will actually help them to get all the products at a better price? Mm-hmm. Even after tariff?
Yeah, well, I think there's two other considerations. So probably in purely financial terms, you're probably absolutely right. Yeah. But think about two things. Number one, do you always buy the absolutely cheapest version of anything you're going to buy? No. Sometimes, yeah, you want a nicer pair of trainers or a nicer phone or whatever. Okay. So it's not simply about producing it the most cheaply. So yeah, it may cost a bit more if you're producing it in the US, but if there's value in what you've produced, the economy, people will pay for that. I think the other thing to keep in mind is you're going to be producing things in a different way. So I've seen one estimate that if you tried to make an iPhone in the US, it would be 3 times the price of producing it in China. But you're not going to try to produce an iPhone in the US in the exact same way that you would in China. It makes no sense. Like you point out, you have a very different balance of capital and labor. So you're going to do it in a different way. You think about here, what about all the implications of artificial intelligence, automation, robotics? So you're going to be able to do it hopefully more cleverly in the US, probably more expensively, but ideally still at a profitable price.
Got it. So talking about US, let's also talk about dollars. Mm-hmm. Dollar is you can say it's a currency which is acceptable around the world, and the entire world economy runs on dollar. Mm-hmm. Correct. So, what do you think the current trend of dollar is after the Trump's administration, and how will it impact the global markets, especially Indian markets? Since you're in India, welcome to India, of course. Mm-hmm. But how do you think this will actually impact the Indian markets, the current trend of dollar? Because Indian currency was, before 2014, before the Honorable Prime Minister Narendra Modi came into the power, the dollar was around 62 Indian rupees. Mm-hmm. Now it's 85. Mm-hmm. Okay. And maybe we are running towards, some experts claim that we are running towards 90, 95. Mm-hmm. Right. So what's your view on that? Is dollar actually strengthening, and how will it actually impact India?
Well, you mentioned at the beginning out, I guess maybe thinking that I'm a smart person and working with other smart people. And I think almost all of us smart people got this expectation wrong about what was supposed to happen with the dollar. Again, go back to what most people thought after Trump won the election. And most everyone thought that the dollar was going to go up in value for a host of reasons. But what we've noticed quite clearly over at least the last month or so, if not a bit more, is it's just the exact opposite that's happened. So one thing I think it tells you is to be humble, particularly when it comes to trying to predict what happens with currencies. Nonetheless, if you think about why was the dollar supposed to go up, and then maybe why it hasn't. So the reason most people thought the dollar would strengthen is that if you think about what explains the change in the value of one currency versus the other, tends to be about differences in growth rates. Generally the country that's growing more quickly should have a stronger currency. And also if interest rates are higher in a particular country, that country's currency should go up. And both of those things on a relative basis were true or seem to be true for the US. So hence, simple, dollar's going to go up. It hasn't, so then you have to ask the question, what was wrong in the analysis?
Yeah.
So it was either that growth and interest rates don't matter, but I think they do. So I think the analysis was right. But what in retrospect, and it's always obviously a lot easier to figure this out in retrospect, but what we missed was a third factor, and a very negative third factor that in the end brought the dollar down. So mystery, what's that third factor? Again, go back to what I said earlier, that initially after the election, everyone wanted to be overweight U.S. equities. And the asset allocation, the investments very much reflected that.
Correct.
After April 2nd, people had second thoughts. And what you saw is, I think, a good chunk of foreign investors selling their U.S. assets, selling bonds, selling equities to buy Indian equities or Japanese or who knows what else. So the selling of the dollar, and a lot of it, is what drove the currency down in the short term. So now your question is, okay, what happens next? And again, I'm going to be very humble here and say, I don't know. But if you go back to the initial analysis, that if growth is relatively higher in the US, interest rates are relatively higher, that should support a recovery in the dollar to some degree, as long as you also think that those sales, those redemptions by forwarders have more or less finished, which would tend to be my view.
So, are you still bullish on dollars? You said there was an overvaluation of the dollar before the elections. People were assuming that Trump will be in power, and because of that, they were very, very bullish about the US economy, and that's why they, in a way, overestimated everything, and because of that, there was a rally. Now you think everything is falling into place at the correct valuation? Is that true?
I probably wouldn't phrase it quite that way. I think more that the dollar, the decline in the dollar was a consequence of the other things. The dollar was overvalued, that it fell subsequently. I just say that enthusiasm for U.S. assets had pushed up the value. Okay. And when that enthusiasm turned to more pessimism, it's come back down. So really the question today is, from today, looking ahead, do you think people are going to be marginally more optimistic or more pessimistic about the U.S.? And that will be at least one of the factors that determines whether the dollar goes up or down.
So why people are pessimistic?
Well, I guess one thing that concerns a lot of people is, on one hand, we knew tariffs were coming. None of this is a surprise. Trump's been saying this for a very long time. But certainly the magnitude of the tariffs that were put into place caught a lot of people off guard. Now, how significant that's going to turn out to be, or those initial tariff levels turn out to be, I think it's a function of what you think the strategy is behind them. I mean, if you think those initially extremely high tariffs, these reciprocal tariffs, right? If the intent was to get people's attention, I think that worked. And
it worked very well.
We're still talking about it. And I would also argue that the intent was to get people talking, or to get the countries talking. And I would say that's worked as well. We're expecting deal with India, between the US and India. You already have one with the UK, China. So as a negotiating tactic, I'd argue it was pretty effective.
Yes.
And now that you've achieved that, at least short-term objective, maybe you don't need those tariffs, those high level of tariffs anymore.
Got it. So that is what's causing, some sense of insecurity amongst investors.
Yeah.
And that's what making them pessimistic about US economy.
For some, absolutely.
For some. Okay. Yeah. So since you mentioned China, let's talk about that. That's another hot topic for today.
Of course.
Impact of China. Now, nobody wants China in the equation of their economy. That's the reality. Let's keep Russia aside. But other than that, US doesn't want it. India don't want to be dependent on China at all, right? But the reality is, right, in today's world, you can't sustain without China, right? All the batteries on which all the EVs are running off a company called Tesla, and whose owner is Elon Musk, who's a very good friend of Donald Trump, someone who's against China, right? So in a way, the global economy is very much dependent on China, if you see, right? It's a production hub, and a lot of natural resources are there in China. So what do you think this trade war, at the same time, the China's policies are and how are they actually impacting the global economy and the global market?
It's probably not realistic, I think, as you hinted, for the rest of the world to decouple, as we say, from China. You're dependent, not so much dependent on China, but it's a critical manufacturing source.
Correct.
That's not likely to change, certainly not in the near term. But the degree, the scope of the relationship, that's obviously evolving as things do. I think what a lot of countries realized, in particular, say during the pandemic and lockdowns, when you suddenly needed a lot of things very quickly, supply chains were disrupted. Ships weren't flowing, so you couldn't get stuff that was being produced in China. And I think a lot of governments didn't feel particularly comfortable with that situation. So one of the key motivations for this desire, I think not only in the US, but elsewhere, to have more domestic production is just a sense of kind of national security, if you will. We need to be able to do certain things here. So I think that's behind a lot of it. And, frankly, when you look at it from that angle, it makes sense.
So what's the solution?
Well, I don't know if there's ever an ideal solution, but, if you can see the tariffs as a means to that end, if there's not a financial incentive to encourage domestic production, even if you say, oh, this would be really fantastic, it's probably a lot less likely to happen. So I think tariffs are part of getting companies naturally to come to that conclusion, if you will, because the financial incentives are going to be pretty clear.
All right. So these were your views on different questions that I asked, right? Mm-hmm. Now, see, this is not a normal podcast and this is not a normal interview. Mm-hmm. Okay. I am known to get out the best from any expert. Mm-hmm. Right. So I'm not very much interested in your view. What I'm interested in is how you get on that view.
Sure.
Right. I want to know how you decide that which sector is good, mm-hmm. or what company is good, or what country is good to invest. I want to know the entire process. Mm-hmm. Now, I know it's decades of experience, but what I wanted to do is I wanted to sum it up and tell me in this one podcast that what's your process of identifying and then making a decision about your investment.
Well, I guess if you're...
and in the simple terms, of course.
Well, I think there's a lot of ways that you can do it. So there's not any one way to make those types of decisions. And different investors, different people are going to have their particular methodology. So I can talk about either how I think about things or how, for example, other investment teams within my company go about it.
Yeah, mostly I want to know how Daneil Morris decides, okay, I'm going to invest in this company. I want that framework.
Well, I tend to look at how the question is you have X sum of money and you're trying to decide where you want to invest that, and you kind of at a high level, you have the question, do I want to be buying equities? Do I want to be buying bonds? Do I want to keep my money in cash because I don't know what to do? So that's kind of the first question. And then once you decide, okay, I want to put a certain percentage of this money in equities, okay, which markets do I think are more attractive? So the first part for me, at least, in answering that question is fundamentally, what do you think is going to happen in terms of the economy? Because if you think economic growth is going to be steady or hopefully get better, for example, if you think of India, growth's quite high. Most people I talk to, the experts that I talk to, tend to be pretty optimistic about the outlook. And then the conclusion just from that observation is you probably would prefer equities to fixed income or cash because you would anticipate a higher return. Now, the opposite of that is if you think there's going to be a big slowdown, you're worried about a recession, well, then you want to be in cash or you want to be in fixed income. So high level, first decision is that. So let's go with the equity bet. Okay, I think the economy is going to do pretty well. I want to invest in equities. In a sense, equity investing is kind of simple. The first point, it really comes down to earnings. Over the long term, the market that has the biggest increase in earnings, pretty sure that's going to perform the best. So you have to start to do that analysis. What do you think earnings growth is going to be? So we mentioned artificial intelligence earlier. And one reason you've seen such good performance for US tech stocks, at times Chinese tech stocks, anything related to the AI, is your estimates of what earnings are going to be like in the future, pretty optimistic. That should result in higher prices.
Correct.
Now, the caveat or the key qualifier to all of that is at the same time, well, it depends on what price. So valuations matter. Mm-hmm. And generally, for any market, if price is too high, it's going to be much more difficult to make money on it. So you want to have some assessment of what you think valuations are. If they're not too extreme and you think their earnings are good, that's probably a part of the market you want to be invested in.
Okay. So you pointed out a lot of things over here. The first thing you decide is the economy.
Yeah.
Correct. The markets, are they doing well or not? How do you decide that?
Well, I think the challenge for so I'm first thing to say I'm not an economist. So what I mean by that is I don't, I don't think number one I have a key core competence at predicting what's going to happen with economic growth. So I probably listen to a lot of other experts in that sense, what other economists are thinking. And you're trying to assess, if you look at what's happening with the labor market, with capital, as you mentioned, if you think you're going to be generating, again, positive as opposed to negative rates of growth for the economy. It's kind of as fundamental as that.
Okay. And then you said you decide on the sectors, which sector is going to do well. Just like you mentioned, the AI and the IT sector specifically, right? So how do you decide on the sector?
Well, it's actually even that question you would want to think about, because first, when you have the equity market, you can think, if I want to allocate more to a particular part of that market, how do you slice and dice the market essentially? So there's a geographic question. Do I want to overweight China or India or the US? So that's one way to go about it. I think the problem with that view, it works in a lot of ways, but let's say you take Europe. So, however many countries there are in the EU, each one tends to have its own equity market. But if you actually study it, you'll see it's kind of hard to say that French equities go up or perform very differently than, say, German equities, because they're in that particular country. Europe's a relatively cohesive place. Things tend to kind of go up and down together. So that geographical distinction kind of only goes so far. So if you say, well, if it's not in terms of the country, you bring up the sectors. Now, at least when I've looked at how different sectors perform over time in different economic environments, it's really hard to find a pattern that you have a lot of confidence in. So for example, let's say inflation's going up. Oh, I should invest in these sectors. It doesn't work very consistently. So personally, I tend to shy away from trying to make calls on sectors. I think that's quite hard to do. Now, not to say smart people can't do that. So you're kind of running out, well, if it's not sectors and you can run out of countries, what do you do? I think at least one way to think about the market that may be a bit simple, but I think can work pretty well, is growth versus value. Okay, so you think tech, so that's a growth style, but there's also things kind of beyond just tech within growth. And again, if you think the economy is going to be doing relatively well, that may be an opportunity. At the same time, the idea behind value stocks is you want to find companies where the valuations are low, but their earnings prospects are still good, and so you see that potential. You see the potential there. So I think there are a lot of ways you can analyze and bifurcate the market, and it kind of depends on what environment you're in, perhaps, as to which way of doing it is the most appropriate.
And then the next thing that you talked about is valuation. So how do you decide on the value, whether this company or this sector or this economy is undervalued or overvalued? How do you decide on that?
Yeah, well, argue as much art as science. There's a lot of ways you can try to measure valuations. There's price to book ratios. So it's kind of an accounting framework. Essentially, you're always kind of comparing the price of this stock to some other metric that represents what I guess the potential or the value of the company is. So that can be the sales of the company, can be the value of the assets. There's actually a whole host of these things that investors look at. What I tend to look at, simply because I think this is how the market functions. What I mean is, I think equity prices, because that's really what we're after here, equity prices primarily tend to move depending on what the market thinks is going to happen with earnings.
Correct.
So if the market suddenly thinks a company's going to earn a whole lot more next year, price tends to go up, and vice versa. So I tend to look at what the market expects to happen to earnings, and I look at the price relative to that expectation. So basically a price earnings ratio, PE ratio, but a forward earnings ratio. So if I see that the price relative to these expected earnings is really high, that's what you would consider overvalued or expensive, and vice versa. And, historically, it doesn't do a terrible job in terms of what the kind of returns you subsequently get on the market.
Correct. So, but these P ratios and PB ratios, as I just mentioned, these are all very simple stuff which a lot of people use. And how does that make you different? And how does that make you the expert? Uh, you know, like heading one of the biggest asset management firms of the world.
Well, I think it's just one of a host of things you take into account. So it's certainly not the only thing that on which you're going to base a decision. But I think valuations are critical. So I think what you find in the end in terms of how one investor differentiates themselves from another, it's what do they do in addition to, say, just looking at valuations, looking at earnings expectations, estimating the growth of the economy. I mean, it's all those things.
You just combine everything and then get on a decision.
Yeah. Well, again, go back to the point I made earlier. There are many different ways to go about investing. So this is one methodology. At another extreme, you could have a very quantitative oriented methodology where essentially it's all mathematical. Well, that there are other type of investors that we call quantitative investors,
Yes.
where it has nothing to do with what you think. It's just all what the numbers say. So, and at times that can perform better, it can perform worse. There's a whole range of possibilities, which is what makes the market, right?
So does quant analysis actually work?
At times, yes, but at times, no, which is why, I guess one of the appeals of investing as a career is it's incredibly challenging.
Yeah.
Because nothing works all the time. If it did, I'd be much richer.
All right. So one more thing that I really want to know is people, they make an investment decision. They invest in a company.
Mm-hmm.
Let's say it's going up.
Mm-hmm.
The values are increasing. He is very happy about it, he or she.
Mm-hmm.
Now, when to stop?
Mm-hmm.
When to exit? That's a big question.
Mm-hmm. Mm-hmm.
What do you think is the right time to exit? Any market, any country, any asset class, or any stock?
Well, at least within our firm, any of the investment teams, as a rule, when initially have an investment case, why we like X, Y, or Z, okay, and then more often than not, you say, okay, we're buying it at this price. If things go well, it goes to whatever price, some positive multiple of that. Things go pear-shaped, it's going to be a multiple that's less than one. And if you're, say, an experienced, disciplined investor, you before the fact have said, okay, if it gets to this level, I think that's the value or the return that I expected to get. And so that's when you would sell. Conversely, if it goes this way and you say, well, obviously, whatever I thought was not right. And so get out. Don't keep hoping, tomorrow it's going to turn around. So it really comes down to having a methodology, whatever that may be. Again, there's no one right methodology. And then being disciplined and sticking to it.
So, sir, that's how we basically choose the stocks, or you basically decide on where you're going to invest. Now, let's talk about India.
Okay.
Okay. What do you think about Indian economy and Indian equity markets?
Well, I can share what the view is of our emerging market equity team. Because they're looking at stocks, obviously, across all of emerging markets. Mm-hmm. And generally speaking, they're, I would say, positively disposed towards India. You see a high growth rate. That's, fundamental if you want earnings to be going up. I think they see potential for continued improvements and investments in infrastructure. And it's actually, talking about infrastructure, I think, relevant because if you recall, a couple months ago, there was a lot of enthusiasm in the market towards Germany because you had this big spending package that was announced and the government was going to be spending, a lot of money on infrastructure for Germany. And, that's great, but it's probably not going to really transform the German economy. You already got a lot of trains and roads and airports in Germany. How much more do you need? Whereas India, you probably do need a whole lot more. So this is why it makes them comparatively optimistic about the outlook. If you've got the government focusing and spending on infrastructure, that has potentially really positive impact.
So there's still a lot of scope for improvement and development and growth.
Yeah.
That's what you mean.
Absolutely.
Okay, that's all true. But, we hear a lot of different stuff about our country as well, right? The first thing is, we talked about China, right? Mm-hmm. And we said, okay, every country is looking for a replacement for China. And they're looking for something called as China plus one policy. Mm-hmm. Mm-hmm. Okay, so that we'll be manufacturing in China. That's where we are dependent on right now. But we don't want to be dependent on China entirely. That's why we're looking for a replacement. So China plus one, and India was supposed to be that plus one, right? But and that's why the Honorable Prime Minister released this policy called Make in India, which is not working really well. Okay, but the intention was to become the China plus one country. Okay, now we think everybody is our friend in the world, but our neighbors like China, first of all, that's not, we don't have a great relationship with that. Then we have Pakistan, Bangladesh, Sri Lanka, everybody is getting against us. Okay. At the same time, when we say US is our friend, I got this news yesterday that Tim Cook was about to make up. The Tim Cook was about to set up a gigafactory to produce the latest iPhones in India. But Donald Trump, he asked him not to do that. Right? This is actually the reality. We know everything is great, and we are like growing every single day, and we want to do this and that. But everything is not hinting towards the same thing. It's not hinting towards it's not hinting towards everything is positive, right? So, and amidst all that, we are in a state of war. In a way, we are in a state of war with Pakistan, right? And in global markets, there's a war going on between Ukraine and Russia, and then Palestine and Israel. Tariff war is going on. Even in this time, Indian equity market is growing, right? So there is a lot of contradiction. Like yesterday only, Nifty crossed 25,000 after a lot of months, right? And a lot of Indian indexes are actually trading at all-time high. So what's actually happening? Is the Indian market actually overvalued, or is this growth actually because of the positive sentiment the global investors have towards the India? And is this growth actually sustainable?
Well, I think it's a bit of both and. So number one, I'd say the fact that the market's at all-time highs, in a sense, economies just grow. I mean, generally there's more people, there's more activity, there's more production. So earnings markets inevitably go up. So simply any market, if it's at an all-time high, well, that should be the case. So in and of itself, I don't think it tells you all that much. At the same time, again, I mentioned before, broadly we see, hopefully positive outlook for economic growth in India and globally. So again, earnings should be going up, and therefore prices for going up. So despite all the concerns that we know are out there, at least so far, don't seem to be significant enough to necessarily change that trajectory.
Okay, that was a very short answer for a very big question, I must say. One more thing that I want to point out is when we talk about GDP, right, a very big indicator for the countries, showing the country's growth. Yeah. We are currently the 5th largest GDP in the world. China is, I think, second or third, second biggest when it comes to GDP. But there's a difference. The difference is China's GDP is based on the production that they are doing, and Indian GDP is consumption based because we have huge amount of population. Our GDP is consumption based, and I've read this that consumption based GDP, they are not very sustainable. Okay, but production based GDPs, they have a huge potential to grow. Now we are trying to be the best in the world. So do you think we can ever beat China when it comes to GDP and the growth rate?
Well, I'd maybe pick up two angles of the question. So one, sound like you're concerned if you're a very consumption-based economy, is that a limitation? Well, the U.S. is probably one of the most consumption-based economies. Consumption is 2/3 of U.S. GDP, which is quite high. And I think in general the U.S. is doing okay. So if maybe theoretically there's a limit, but I don't think that's the key concern for China. Excuse me. Don't think that's the key concern for India. Then on the flip side, you talked about China's economy being based on investments, which is true, and that clearly that's supported fantastic growth over the last decade. I would actually argue there's probably more question there, the sustainability of that model. because at the same time we appreciate China has issues with the property market overhang, and essentially investing generates growth initially, especially if you have a low, relatively undeveloped economy, but eventually, in a sense, you can invest too much. And if you look at what's happened with the property market in China, you'd say that's what's happened. You have kind of too many apartment blocks and office buildings relative to the demand.
There are ghost towns, I guess.
Exactly. So I don't know if we're going to have such a straightforward analysis, say, oh, consumption good or bad, or investment good or bad. It depends. But I think at this point, at least as far as India is concerned, having a more consumption-oriented economy, to me, isn't an obvious hindrance right now.
Got it. So there's not a problem as of now?
I don't. Not an economist, but I don't think so.
Okay. So you're still bullish on India?
We always see opportunity, and I'd say generally positively disposed. Or as I said, our emerging market equity team is positively disposed towards India.
Perfect. Good news for all of you, right? You also mentioned about AI, right? So AI is the new revolution, I can say. Correct. So what's your view? Because see, I'm all about AI. So we might have editors with us. We have the entire team working with AI, right? Trying to merge AI with everything. But the problem with this is we are growing too fast in this particular stream, right? There was ChatGPT, very famous, right? Everybody was very bullish about it. And then suddenly there was DeepSeek. Correct, and the stocks of ChatGPT and all those companies who were working with ChatGPT, they crashed, right? So, how do you actually go ahead with investing in AI?
I guess actually is going to reflect one of the fundamental principles of investing, which I think is diversification. I'm certainly not smart enough to know, okay, it's going to be this company that's going to win this particular race. So I think you want to be exposed to the space broadly. We talked about growth stocks. Think about the NASDAQ, so it's going to be one of you would anticipate key beneficiaries of the development. And I think if you have a broad exposure to that part of the market, ideally you kind of win either way. So even if it's not this company, it's someone else. So I think that's maybe one of the ways to square that circle is you can hopefully capture the growth without having to necessarily pick who's the winner is going to be.
And do you think this market is anywhere near to saturation?
I don't think anyone would hazard a guess on that with much confidence. As you pointed out, it's so volatile and it's so new. There's going to be a lot of surprises and innovation. So I think that kind of goes with the territory. But at least so far, well, maybe to give you one concrete example, I think we've read about a lot of companies, particularly in the US, spending a lot of money investing in the development of these models. So capital expenditure for these companies. And then you kind of wonder, well, is that really happening? Well, if you take the first quarter GDP for the US and you look at the detail, you see two things. Number one, that actually there was a significant increase in business investment in the US in the first quarter. And you say, well, gosh, where was that business investment taking place? And the vast majority was in information technology equipment, i.e. you're imagining it somehow related to AI. So companies are spending a lot of money. That's kind of the easy bit. The real question from an investment point of view is what kind of return are they going to get on that investment? And that's where you're really making that decision and betting on the future.
It's more like a bet, right? It's not a very wise decision. That's what you want to say?
Well, I think any investment is implicitly is a wager on what the earnings growth is going to be. I think that's inherent certainly in any equity investment.
So this is like even if you're investing in a company's equity, which is basically working in the field of AI, it's more. You can say that it's more volatile, it's more risky than any other investment?
Yeah, well, certainly if you define risk by volatility, because there's actually a whole question in itself is what is risk. But I think you see that with if you compare the volatility of NASDAQ versus, say, the volatility of value stocks or defensive stocks, clearly NASDAQ is going to be higher, but, risk reward, they are positively correlated, they go hand in hand. If you want one, you tend to have to accept the other.
So basically it's like, there are a lot of companies which are working in the AI space, right? And they have their own apps and new technology, working on new models. Okay. And the problem with this is the moment one company let's say a new company comes up with something which is much better than the rest, all other companies, they just crash. That's exactly what we saw in the case of DeepSeek, right? So, I mean, of course, we are investing in the future because AI is the future. But don't you think the future is very dark when it comes to investing?
Well, historically, I don't think that's been the case. Equities and fixed income, for that matter, over the long run, done well. Markets are going up. I think you mentioned Indian equities at all-time highs.
Okay.
So I don't know if I necessarily think it works that way. And I guess the other thing I would ask is, if you take DeepSeek, I mean, yes, the initial reaction in a lot of the competitors was negative, but pretty sure that everyone's now well above the level they were at before the DeepSeek announcement.
Absolutely.
And then what I think that reflects is, one of the concerns people had is it seemed that DeepSeek was doing a lot of what the other companies are doing, but for a lot less money. So,
Yes.
hey, why am I spending more money for those? But I think what we've seen since is that even if it does seem we can do a lot of these AI things more cheaply, but that just means demand goes up. And we've seen this in technology over and over. Phones are cheaper, you just buy more phones or whatever it might be. So I think in terms of the pie, it's still getting bigger, even if we can talk about who gets what slice.
That's a good point. Got it. Now coming to a word that you just mentioned, that's diversification. Okay. Diversification, there are people who diversify their portfolio with different stocks. That's the first level, the most basic level of diversification. Then they invest in different assets or asset classes like equity, and then gold, and then real estate, and then some people also invest in global markets. That is another level of diversification. So firstly, how do you see gold as an investment?
Well, I can say for our multi-asset team, so they're doing exactly that. They've got money basic client money to invest, and they're trying to take that decision. Okay, is it fixed income? Is it cash? Is it gold, or so on? And currently, they have a slight overweight to gold in that portfolio. So they do see potential, but that's not necessarily premised on the idea that gold prices are going to continue to appreciate a lot. I mean, there's many reasons you can choose a particular investment. And I think when you look at gold in particular, there's the value that gold has as protection, if you will, for a portfolio, as a hedge, to use a bit more technical term, for the portfolio. So if something bad happens and equity prices go down, gold probably won't go down as much. If you're worried about inflation, if inflation accelerates or increases, a lot of time bond yields go up and the bond price goes down. Gold probably will do a bit better. So even if you don't think gold prices are going to go up, you probably still want some position in it because it protects your portfolio in case other things happen.
But a lot of central banks are now, trying to store more and more gold in their depositories, right? And that is one of the major reasons why the valuation of gold is actually increasing a lot. So do you think it is the correct value right now, or?
Well, I think one of the challenges with gold, so we talked about price earnings ratios before. And when you think about commodities, you think about gold, it's more difficult to analyze because there's not an obvious way to measure value for gold in the way that you can for an equity. So I think you have to think about the question in a slightly different way.
That's a problem with, I think, all the commodities, right?
Yeah, well, exactly. Yeah, so it's a fundamental. There's not an obvious inherent valuation way that you can look at it. So you talked about central bank purchases. We do anticipate that will continue. Would anticipate that that's going to support gold prices. But the point I guess I'm trying to make is, even if that doesn't happen, we still like gold within the multi-asset portfolios.
Got it. And do you think it is important to invest in global markets? Like, of course, in India, we are investing in Indian equity, right? But, and of course, gold and real estate, it's, of course, also a cultural part. But do you think it is important for everyone to invest in global economy? Global markets, actually.
Yeah, ideally, but when you go back to why do we say you should have a diversified portfolio? Because the idea is, well, if some bits go up and other bits go down, you've always got something, hopefully, that's going up. So hence diversification. The dilemma is that what you find, particularly within equities, is let's say you just have an investment in a particular country's equities, say just India, as opposed to global. what you find is equities tend to go up and down everywhere.
Correct.
So just because you had something outside of India at the same time that you had India, it's not so likely that India would go up while the other ones are going down, or vice versa. So there's a marginal benefit, I think, to having global diversification. And though it may be ultimately not so much the benefits from that, but just, there's a whole world out there, and there's going to be other opportunities that you're not going to find solely in India. And that may be the better perspective.
Got it. So how much percentage of your portfolio should be consisting of, maybe US market equity or maybe some other market equity?
Well, I think to answer the question, most people start with is the benchmark for global equity. So the MSCI All Country World Index. So people are familiar with ACWI. So that is essentially what people are going to say is the neutral allocation. So I think it's kind of safe to say, well, whatever the allocations are within the MSCI All Country World Index, that's probably a good place to start.
Got it. All right, sir. I think that will be all. Any parting words that you would like to say to all our audience who's listening to this podcast? I'm really, really sure they must have got something really valuable after listening to this. And of course, thank you so much for being here and being a part of this podcast. So how was your experience, to be a part of the best capital market podcast of our country with the best capital market podcaster of our country? How was your experience?
Absolutely something I'll remember for a long time.
Perfect. Any parting words for all the audience?
Well, think about principles of investing. I mentioned being disciplined and trying to keep your calm, keep your cool, which these days admittedly can be a bit challenging, but it tends to work in the long run.
Got it. There's no better way to end this podcast than this. Thank you so much, sir. It was an absolute pleasure having you here. And I really hope you guys got something really, really valuable from this podcast. I did. And I'll see you guys with more such informative content. Till then, like this video, share this video, and I'll see you in the next one. Till then, keep learning and keep trading and investing with Dhan. Bye-bye.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.